all of us think that current times are very tough. When we look at the past, and there is a lot of work in behavioral finance about this, when we look at the past, even though the past was not rosy, it always looked great.
Yeah.
And why? The behavioral bias that we have is because we survive it. We remember that we survived it, so the past is always okay.
Yeah.
The present is not okay.
In this episode of Seeking Wisdom, Wealth, and Wellness, host Jonathan Satovsky converses with Eduardo Repetto, Chief Investment Officer and co-founder of Avantis Investors. Eduardo shares his transition from aeronautical engineering to finance, emphasizing the importance of understanding valuations and behavioral finance.
Welcome to this episode of Seeking Wisdom, Wealth, and Wellness. I'm your host, Jonathan Satovsky of Satovsky Asset Management. And today I'm speaking with Eduardo Repetto. I've happened to know him for over a decade. He's a wonderful, wonderful human being, super smart, a visionary in the world of finance, a leader who's made significant contributions to the investment industry. Dr. Repetto is the Chief Investment Officer and the co-founder of Avantis Investors, a renowned unit of American Century Investments, which boasts an institutional quality investment platform with, I think, roughly in the ballpark of $207 billion, give or take, depending on the day, in assets under management as of September 30th, 2023. It's one of the fastest growing ETF issuers in the industry, and with a background in fascinating aeronautical engineering. He's used his passion for problem solving to refine the world of finance. As CIO of Avantis, Dr. Repetto is responsible for directing the research, design, implementation of their investment strategies, not only as an expert in quantitative methods, but also a key figure in the firm marketing initiatives. He plays a vital role in interacting with clients, which I've been a beneficiary of. Before founding Avantis, he was the chief executive officer and co-chief investment officer at Dimensional Fund Advisors. Thanks for spending the time, Eduardo.
It's a pleasure. Such an introduction. Just my goodness.
Well,
amazing.
You know, I always I want to start with something a little different. I've always found that you to be a really disciplined person. You know, we met, I guess, a decade ago, and you were telling me about the processes to which you've evolved. Can you give me a little background about how aerospace engineering has morphed into the discipline of problem solving in the investment world?
Oh, yeah. So my undergrad is in civil engineering, so it's even more weird. So I got an undergrad from Argentina in civil engineering. Then I went to Brown University, and I got a master's in mechanical. And then I got my PhD in aeronautical engineer from Caltech. But my PhD was, when I say aeronautical engineer, it doesn't need to be every aspect of a plane. I was working on theoretical and numerical models to understand materials, and some materials need to have special properties in order to behave the way you want when you are under high stressful situations, like when you are in planes, rockets, in particular high performance vehicles. But so you learn a lot about mathematics, you learn a lot about physics, you learn a lot about optimization, a lot of weird things, but those weird things are tools that can be applied to many, many different aspects of, natural science or social sciences. And so if you think about finance is about understanding data, and understanding models, understanding behaviors, and trying to frame that in a way that you can use it in order to create better outcomes. And so that's basically what I have been doing since I started working in finance back in 2000, trying to understand all the different aspects of investments, from the stock picking or bond picking to the client behavior and the client portfolio and the client goals, and trying to put all that together in a way that you can deliver better solutions.
I love that. It's astounding the track record and the success you've had since beginning in the field. Really, really, congratulations.
Thank you.
I mean, since you launched Avantis in 2019, you grew it from nothing to $12 billion
So yes, we started in September, end of September 2019. Now we are around 30 billion. We crossed 30 billion last week. And so we have been growing. I think that, as you said before, we are the fastest growing asset manager in the world, according to CityWire. And the concepts, you have, whenever you think about investments, for me, you have to have a theoretical framework, and you explain it very well in very simple words, even though it's more complicated, but in very simple words. You have a company paying a stream of cash flows, dividends, earnings, you want, whatever you want to think. You have a company that has a balance sheet, that's assets minus liabilities. And if I tell you, go and buy that company, what do you want to pay for that company? Very high price or a very low price? And probably you want to pay a low price, right? So you have those cash flows and that balance sheet bought at a very, very attractive pricing. And if you buy it at an attractive pricing, you're going to have very high expected returns. So that's a simple concept based on valuations at the end of the day. And you can apply that concept and go historical and say, will that work if I would have been in the past investing in this way? And when you do this empirical analysis, you see that it will have worked in the US, in large cap and small caps. It will have worked in international markets, in emerging markets. It should work because theoretically it's telling you this should be a good investment if you buy it at low enough price. And so when you see that it works theoretically, works empirically, then you feel very comfortable that you can create a strategy that will add value to investors. Now, there is a lot of people in the world trying to do many different things. Some people, don't think about investments this way. Some people try to follow trends. And, there are things that are hot today because they may have performed great last month, last quarter, last year. And they say, oh, this has been doing great. Let's buy more of that. Well, that sometimes doesn't work. Most of the time doesn't work, because if you think about that, you're buying something that went up in price. You should have bought it a year before, a quarter before. Once you get there, maybe it's too late. And so, there you have a trend following strategy that is quite common, that is even very, very common with retail investors not having an advisor guiding them. And people do it. At the end of the day, valuations matter. And if you can't think about valuations and apply them right, you should have a good investment experience.
It's interesting. I have such a resonance intellectually. It makes such sense to buy cheap. I think, at Dimensional, you were heavily focused on two dimensions originally, cheap and smaller companies. And over the last decade, profitability became a more accentuated factor, which is really, sort of turbocharged things, I think, for you. Why aren't more people doing it? I mean, it's so logical. Why do you think more people don't adopt that? I guess the word I keep coming to is people get stuck in heuristics or discipline or lack of discipline, right?
Yeah, look, there is a little bit of everything. Every discovery is obvious after the fact. So think about that. I always think about having an ulcer. When you have an ulcer in your stomach, if you go back in time, grandma used to tell you, have milk or have yogurt or something like that.
Yeah.
And some Australian doctor start thinking, that cannot be the answer. It has to be something. And he discovered there was a bacteria producing ulcers. And so you have just an antibiotic, just a pill, and that cures that. And after the fact, it's so obvious, so easy to treat and whatnot. But before, we have centuries and centuries trying to have heuristics that really didn't do much. Finance is the same, at the end of the day. So you have science that is evolving, science that is getting better, and some people are not at the cutting edge of science, at the cutting edge of data and implementation and processes. And if you are not there, you live in the past, and you're just trying to come with some magic to create portfolios. And that is something that sometimes doesn't work. It's much, much better to use all the knowledge up to date and try to create better portfolios. And that's where we stand.
And I was just reading this week that the top two companies, Apple and Microsoft, represent over 14% of the weighting in the S&P 500, which is, I think it's going back to IBM and AT&T since that's happened. And it's fascinating how these, as they call them, the enormous eight, have really dominated the headlines, or whatever. You could take out the 493 other companies in the S&P 500 and you would have generated no return this year. So your point about hindsight bias is not lost on the fact that it plays out daily, weekly, yearly. I wonder, what is the key differential of your approach at Avantis, of how you've done it relative to how you were doing it at Dimensional, which is directionally in the same philosophical direction of how you're going about it? What's the change?
Yeah, there is a lot of companies that think more or less the same. Even if you think about Vanguard, for example, they think about, hey, forget about the stock picking, just use prices and buy market cap weighted portfolios. So when you buy a market cap weighted portfolio, the only thing that defines the size of the allocation, how much you allocate to the company, is the size of the company. The bigger company, bigger size. Dimensional came we start implementing what's called factor investing. And so, like you say, Dimensional is to say three factors. First, one factor, by the way, small cap companies. If you buy a smaller cap company, you should have higher returns. And
Right.
that's a small cap premium. Then the value factor, say, if you buy companies that have low price to book, to the balance sheet, low price to the balance sheet, well, you should have higher expected returns. And then later, because of the work by Ron and Novi Marks, the idea of profitability. Companies that have higher profitability should have higher returns. So if you start thinking, I'm analyzing a company piece by piece, you are large or small. And then I decide you have higher expected returns. Then you're saying you have low price to book or high price to book. And if you have low price to book, you have higher returns. And then I say, hey, you have high profitable and low profit, and then you have higher returns. But that's not integrating the whole view of a company. Because if I can give you a company have low price to book, but have horrible earnings, very bad earnings, net operating losses. And that's not so attractive. So just thinking about low price to book doesn't tell you the whole picture of a company. Or I can tell you a company have very high profitability, but the price is extremely high. That will not be so attractive. So what we came here is start saying, we have enough data, we have enough science to try to think about the company holistically. Think about the whole valuation of the company. Think about what is the price of the company. Is the equity, assets minus liabilities. You can use book as a proxy for that, or a modified book as a proxy for that. And the price of the company is more just the equity. It's also the cash flows. But the cash flows, are money that coming in the future. So you're not going to pay $1 today for $1 in the future. You're going to discount it by some discount rate. There you have the price is the equity plus the cash flow divided by some discount rate. What companies are interesting? The ones that the market is pricing with a very, very high discount rate. Something that is think about on sale. If let's say you go to a restaurant and the restaurant says today, sushi 50% off. Say, wow, let's have sushi today because it's 50% off. The same story.
Assuming it's not spoiled sushi, yeah, of course.
Very good sushi, 50% off. And so that's very, very important point. So what you want is things that are on sales, things that have a very high discount rate embedded in that price, not things that have low price, because you can have low price because your balance sheet is bad. You can have low price because you have no cash flows. Yeah. And those are no good outcomes. That's your cheap sushi because the quality is not last month sushi. That's not good. No, we know that. Yeah. So what you want is something that is trading at a big discount. And that holistic view of a company is what we have implemented here at Avantis that we think that makes sense. It's basically the holy grail, if you start thinking, trying to come to understand valuations of companies and when companies are attractive. And active managers have been trying to do that forever, and they have their own issues trying to do that. Now, today, with science and data and processes, we can implement that more systematically.
Would you say that the advent of technology has, to some degree, when someone says, I happen to think those top 7, 8 companies are valued very high because they represent a large percentage of the economy that's investing in AI. But I would view that what you're doing, I perceive that what you're doing is actually using AI and technology to operationalize that process to a much more effective way for the benefit of the consumer net of fee and net of tax. Is that a fair way to think about it?
Yeah, yes, it's operationalized, systematized in a process where you can identify companies in a very efficient way, so you can do it at a low price and achieve great diversification. Because if you have to do one by one, you don't have enough hours in a day to analyze a lot of companies. So you have to do it very, very efficiently to analyze a lot of companies at a very low cost, so you can deliver good portfolios.
All right, let's go to a different topic. It's reported that only 57% of U.S. adults are financially literate. I know myself in college, the only reason I got into the field of financial planning and wealth management is because they don't teach it in high school and college. So I figured, I'll do it for 2 years and I'll go do something else. But it turns out the vast majority of people specialize in something. They're professionals in something aside from this. That being said, only 57% of U.S. adults are financially literate, as measured by them showing knowledge in at least 3 or 4 basic financial concepts: risk diversification, numeracy, inflation, and compound interest. But if you had the superpower to help investors by banishing one harmful behavior or blind spot, what would it be?
That's a great question. And I agree with those statistics. Look, I have 3 boys. The oldest one is now 21. And they never took a course in finance.
Yeah.
Not in elementary school, not in middle school, not in high school. And the ones not studying economics, one is studying economics, not in university. And then they go to real life and they have to start dealing from day one. Even when they're in college, they have to deal with financial decisions. Should I take a loan? Or should I buy this? Should I defer payment? All of us make financial decisions, and pitifully, not all of us have taken courses teaching us how to do that. But I think that the worst thing is probably overconfidence. If you were able to solve overconfidence, all of us will be more humble and look for help. So if I'm trying to do, a medical procedure, I don't get a knife and cut it and solve it. I go to the specialist.
Right.
Because I don't have overconfidence when it comes to have surgery on myself. No, very simple. Why should I have overconfidence when it comes to making financial decisions, like investing all my savings for retirement on my own picking stocks? I should go and hire someone that can help me, or dealing with complex tax situations. And so there are so many people that know so much. Financial advisors, can be so helpful that if we solve the issue with overconfidence, I'm pretty sure people will say, I need help. I'm not a professional. I'm not the person that should be doing this alone. And this probably will create better outcomes.
It's funny. I was doing a calculator on compounding just to illustrate for someone, because someone just sold a business and they're sitting on a very large amount of cash because today they're getting a very high yield in cash, 5%, so they're like, okay, I'm happy with a guaranteed 5%. I don't have to live with the ups and downs of what happens in the market and worry about the news. And clearly, because they haven't had experience and are educated, their mind is, I'd rather certainty versus uncertainty. And as we sit here today, I think there's record amounts of money market balances, records. And historically, I think cash 3-month T-bills have returned, I think, 3.3% odd, bonds about 4.8, stocks around 10, and small companies around 12, over 12. And so just framing for someone that $1,000 investment, would the growth of, $1,000 growing to 3,000 in a course of, let's say, 30 years, in T-bills, that same amount of money invested in stocks would be worth 175, 17 times and 31 times in small companies. So how do you get people to have longer holding periods? Because you have some tremendous construct in what you're doing. The question is, how do you get the advisor and the consumer to behave and to hold on long enough to benefit from that compounding?
Yeah, look, all of us think that current times are very tough. When we look at the past, and there is a lot of work in behavioral finance about this, when we look at the past, even though the past was not rosy, it always looked great.
Yeah.
And why? The behavioral bias that we have is because we survive it. We passed. We remember that we survived it. So the past is always okay.
Yeah.
The present is not okay. The past used to be full of uncertainty. Since it's part of the past, we already survived it.
Yeah.
There is no uncertainty. It's certain. We know the outcome. It was a good outcome. We survived. The present is full of uncertainty because we don't know where the present will take us. The uncertainty in the future. So that's why people sometimes just completely full of anxiety go and buy money market funds or T-bills because that brings them more certainty. But the more certainty that you have, probably the less returns that you're going to get. You have, buying a T-bill is not the same as buying a corporation, because you buy a corporation, probably you can make more money, but there is some possibility that you are not going to make more money. And so, how to help people understand those concepts and embrace uncertainty, reasonable level of uncertainty, diversified level of uncertainty in order to achieve greater expected outcomes is probably the right thing to do, but it's difficult. The first thing that people have to do is engage with someone that understands this concept. You understand this concept. You are a professional. You have been doing for a long, long time. You understand the rational and the financial aspects and also the behavioral aspects. And you put that together for your clients. My mom is not a financial professional. She used to be a teacher. Now she's retired. She was never exposed to that. If she doesn't get help from someone like you, she's not going to make the right decision, and she probably will have growth her asset at the level that you say, T-bill level at best.
Well, the risk of the T-bill level, I think people get caught up in the hidden risks of inflation and taxes and longevity risk. So people think that they're playing it safe, but actually they're doing potentially more harm than good. It's sort of like, it's cheaper to eat a McDonald's burger today, but certainly my health isn't going to be as good over time if I don't seek out some broccoli and spinach and some healthier food along the way. Anyway, so yeah, behavioral finance certainly plays a significant role in balancing people's short-term goals and long-term needs. I think Avantis has actually done a very good job with their communication, but how do you view Avantis's role and responsibility as an investment provider to help clients, to educate clients and help them navigate these behavioral challenges of investing and staying focused on their long-term objectives? How do you see that playing out?
That's a great question. And we engage with a lot of behavioral finance professors, and because the more that we understand the end client, the more help we can provide. Like, right. For example, I didn't understand the name FOMO. I didn't even know what FOMO meant like 5 years ago. It's not part of my lingo. Yeah. And now I understand. And now I understand the concept of just, hey, I'm going, this stock is going up a lot, even though the price is super high. I have fear not to be there because my neighbors are there, and concepts like that help us frame questions and frame material so we can create a lot of marketing material that can help advisors communicate these concepts to end clients. And if someone already hears that before they are exposed to the decision process, they can react better. If I tell you, hey, if you're going to cross the street that has a lot of cars and the light is green, that's dangerous. And when you were a kid, you didn't know that until your mom told you, hey, don't cross when the light is green, wait until red. And now you know, and so much. So if we can empower advisors with a lot of material that is appealing, so they can communicate this concept to their clients, their clients will react better because they are already exposed to the knowledge, and probably they will be long-term shareholders, very long-term successful shareholders.
Yeah. Well, you hope so. You hope so. I have young children myself, and they get fascinated with some of the um, technological evolutions in things that Elon Musk is producing, for example. That is just so profound that it sort of captures everyone's imagination and attention, and they're like, "I want a piece of that." It's very seductive, certainly, and they don't.
That's a great point. So let's go analyze that. Something is very amazing. A company is amazing for whatever reason you think that are amazing. That doesn't mean that it's a good investment. Because if I give you a company that is amazing, but the price that you pay to get a share of that company is extremely, extremely high, the company may be amazing, but the investment may not be as good as you think the company is. And so
Right.
everything depends how much you pay for things at the end of the day. You can have a company that is making a lot of profits, but if you have to pay too much for those shares, your returns probably are not going to be so high.
That's
So
a key thing,
that's the key.
and the risk that someone is the blind side of that risk. I mean, certainly anyone who lived through 2000 to 2002 would recall that with vivid recollection, no doubt.
Yeah.
So diversification is a fundamental concept that everyone talks about in investing, and it seems to. Could you elaborate on how you think about diversification principles in building portfolios? Because conceptually, I 100% agree that buying cheap, small, profitable companies makes sense. I usually use the joke, look, if I sold my business and you wanted to relax and turn off the news and be able to go kite surfing, what do you need? I don't care whether it's a pizza shack or a surfboard stand. I want a cheap, profitable company so I could benefit by the dividends and profits of other people's labor. That's freedom to me. So why diversify, and how do you think about it, managing risk in light of constantly shifting market landscapes, when I totally buy into that simple philosophy that you've ascribed?
Okay. Remember when we were speaking about overconfidence being one of the main risks that we face? Okay, let's speak about overconfidence. Let's suppose that I think that I know, what company is going to do great. I
Yeah.
know, I'm 100% sure. There
Yeah.
is no doubt that I'm right, that little company out there is going to do great. If that's the case, I don't need to be diversified. If I were right, I don't need to be diversified because that's the best investment in the world. I should buy it and move on.
Right.
But that's assuming that I'm right. That's assuming that I know the answer of the future. That's assuming that I have the best crystal ball that is going to tell me where things will go. That's overconfidence. The truth is that the world is full of uncertainties. The truth is that we don't know the news that are going to happen tomorrow. We don't know tons of things that are even happening right now because they are not public until a few minutes from now. And so given that uncertainty, just putting all your eggs, buying only one egg instead of putting a diversified set of eggs in a diversified set of baskets is probably not a good idea. So having a lot of companies that have similar characteristics, being profitable, having low price, having good balance sheet, if you have many of them, all of them are good. You can say, well, this is better than the other. But the truth, there is uncertainty. There is no news in the future that are not here today. And given all that, buy a bunch of them, not one. Because if you have bad news in one, it's more rare that you're going to have bad news in all of them.
We call it the unknown unknowns that you're trying to protect from,
Yeah, absolutely.
So on a more fun note, just to wrap this up, what have you read lately that you'd recommend, whether fiction or nonfiction, business or pleasure? Anything that you read for leisure, if you have any leisure time?
Yeah, I read a bunch of things. First, I always like to read the news, international news, everything. But on the book, I was very lucky to have very good education and from amazing universities. I'm now in the board of Caltech, and we put fellowships there. So I didn't pay for my studies; I got fellowships. So with my wife, we just donate money so there are fellowships to other younger kids to get the same privilege. They were going to top schools the way that we did. And so I've been fascinated how science and education can help not only our standard level, but also democratic processes, knowledge of, spread of knowledge. So the president, John Hopkins, put out a book, What Universities Own Democracy. And I've been reading that book. I think it is a fascinating book because, it's good for us to understand how we can get the whole society forward. And I think universities play a big role in that.
Awesome. And then lastly, if you're an alter ego career path, a road untaken, what would it be that would surprise most people?
You think that I would say a rock player, but I don't know. I cannot sing. Or I'm from Argentina. You say a soccer player, but I'm too big and I'm too slow. So that's difficult. Probably I will be a professor.
Well, I thank you so much for spending the time with us today, and congratulations on success, continued success. Thank you for bringing forth some amazing ideas in execution and making them available to advisors and investors to be able to help enrich people's future. It's a privilege to spend the time with you.
It is my job. It's my job, and we take it seriously. Try to help investors, and we take it seriously.
Yeah, you're good. So subscribe free to Wisdom, Wealth, and Wellness anywhere you get your podcasts and on YouTube, and at satovsky.com/podcast. If you want to book a consultation with one of our advisors on our team, visit satovsky.com and click on Get in Touch. Have a wonderful day.
Are you ready to take control of your financial future? In Jonathan Satovsky's book, Your Rich Life, he offers a roadmap to build wealth with purpose, live with intention, and create a legacy that lasts. Transform your mindset, unlock your potential, and live the life you've always dreamed of. Your Rich Life, available on Amazon and Audible.
Satovsky Asset Management, hyper-personalized wealth management that has created joy and abundance since 2007.